Good morning, ladies and gentlemen. I can't show you the usual risk dial screen this morning because the site is down. We're going to be working on it. But in any case, nothing much has changed over the course of the past week. We're still somewhere in the 30s, in the negative 30s, still the same story. Still risk off, still prefer bonds to risk assets. So what I want to do this week is actually concentrate on an interview that Stan Druckenmiller gave, and you can see it here on YouTube. I very much hope that you will watch it in its entirety because it explains certain things extremely well, and I think it actually absolutely agrees with my analysis of what is happening and what will happen in the future. I have summarized here some of my main takeaways, and there are really things that I've been repeating here for several weeks, if not months. The first point is that you should completely ignore 2020 S&P earnings. The market is not concentrating on those. Individual shares might gyrate a little bit because of what earnings are reported at the moment, but that is not something the market is hugely concerned about. We know about the lockout, we know that the earnings are going to be weak. We are really concentrating on what's going to happen in 2021 and 2022. That should be somewhere around $170 of earnings as an average. And really, if we look at a multiplier of around 20 for 2021 and 22, that is not a low level, but it's not that high either if long-term rates stay low, as they are. If 30-year bonds are, sort of 1.5%ish, then times 20 multiplier is not ridiculous. Certainly times 17 is not ridiculous, and times 15 is actually cheap. So, you know, can the market do better? Yes, it can. Can it do a lot better? No, it can't. Now, what that argues for is a range that we will not be in a 2200 range, as he mentioned, but we will be, the Fed liquidity has got the market back up to 2900. And can it do much better than 2900? Well, probably not for the time being. Now, this is a very important part of the equation. The first round effects of the virus are very deflationary. You cannot argue with that. The market response is correct. Bond yields are down and they will stay down for the foreseeable future. But I would argue that the second round effects, which is a deglobalization, i.e. globalization was deflationary, deglobalization has to be inflationary. If all the supply chains move away from the low-cost countries like China, and they might go to another low-cost country like Mexico, let's say, but that is still not going to be as cheap as the Far East, and that will inevitably have an effect on inflation going forward. But that is not a battle that is going to be fought now during the crisis, but a battle that will be fought in 2021 and 2022 when the primary effects of the virus have receded. That to me argues eventually for a steeper yield curve. But at the moment, my argument, and I think Stan Druckenmiller's argument, is that bonds and equities are very much tied at the hip. Equities can stay up here only if the multipliers are high, and multipliers can stay high only if bond rates are low. So if you get a shock in bonds, that shock will be very much reflected in equities, and the other way around. which is this point here. When if Treasury funding needs overwhelm Fed QE, and he's arguing that it's very close to overwhelming it, and it will be completely overwhelmed sometime in the autumn, the main effects will definitely be seen in risk assets, and that is in equities, because that switch out of risk will support bonds. But it will be probably a question of what goes down most or least, as the two asset classes are now tied at the hip, as I'm arguing up here. I think that you will see that for the rest of the year, bond rates will remain low, and equity prices will probably do slightly worse from these levels than bond prices, but I don't think that the mismatch is going to be so huge because of this point here. The buy the dip in tech growth against the index, at very least, is a secular trend. As he argues, we are only in probably the third, fourth, fifth inning of this huge move of tech growth outperforming everything, and that is why I'm surprised that the spread between the Nasdaq and the S&P has moved so little in the past month, and I would argue that it probably needs to move far more in the next several months. This quote is actually from Paul Tudor Jones, as opposed to Stan Druckenmiller, but it's just as valid. Let market price action guide your decision making, and then try to understand the fundamentals. They become more evident and comprehensible. Quite often, how the market responds will be at odds with your priors, and I've found this to my cost many, many times. Just because you have the right narrative and you have the right logic does not mean that the market will respond that way, and naturally price is king. So we still need to examine the charts all the time to see what the market is telling us and whether it's validating our logic or whether it's denying. The market logic is basically reflected in the yield curve. That is my main tenet, has been for decades, and I see no reason to change it. Now, the 2s10s or the 2s30s or whatever it is that you prefer to look at tell the whole story of what the market sees going forward. Now, I think we can all agree that the 2-year note is dead for the foreseeable future. The Fed has told you so. Rates will remain low for a protracted period of time, and certainly well past the end of the coronavirus crisis. That is, years away from a move in Fed funds and from a move in 2-year rates. The 2 years are now anchored. They will trade in a 10, 15, 20 basis points range. Who cares? What happens against 10-year notes is actually purely a reflection of where 10-year notes trade. So it's actually quite easy to see what is going on. If we start trading above 53, we have an environment in which the 10-year is weakening, and therefore an environment which is probably saying that we are entering a period of risk on, but mildly so. We would really need to trade above 74, 75 for that to be a real risk on. However, if we start falling below 35 or 30 basis points, and I would argue that 30 is even more important than 35, and will certainly confirm 35, we will be in a very, very risk-off period of time. while we keep on trading between 53 and 35, we are in I don't know, let's keep it stable. And I would say that the S&Ps would trade between a maximum of about 30.28 and a low point of around 27.20. So, that's a 10% range. That's a reasonable range for the S&Ps, while the yield curve just fluctuates up and down without breaking the very important 30 to 53 area. We are in a global world at the moment, in terms certainly for financial assets, and will remain so, regardless of what happens to supply chains. The markets will remain very interconnected for, certainly for the foreseeable future. So the relationship between 10-year Germany and, which is the anchor of the EU and of the euro, and therefore the dollar, and the 10-year note is extremely important. You can see what worries me is that we've had this huge move, over 1% in narrowing of the spread between the 10-year and the Bund. And what effect has that had on the dollar? Absolutely nothing. To me, the dollar is the thing that can wreck any forecast that we have at the moment. An appreciation of the dollar at the moment would be very unwelcome by certainly by the central banks, and has the potential to wreck a lot of economies in the Far East, and probably throw the world from a sort of a multi-quarter recession into some kind of a longer-term depression. I'm very afraid of the dollar, but this chart tells me that unless we can start breaking back up above 125 and go towards the 150s, the danger is that we break below, and the danger is that bond yields break lower and lower and lower, and that is very, very risk off. To me, that would only happen if the dollar starts breaking upwards, and I'm paying very, very close attention to what signals the dollar is giving me at the moment, because that, I recognize, is one of the narratives that could not fit in with my worldview for the next several months. And this is the chart of the Dixie, and it's worrisome, because we keep on failing to remain in the main range, which would be this range between 98.50 and 93.14. We keep on breaking above it and not being able to stay below. We are now approaching, the last levels of resistance before we start breaking up towards this 103 area, and above 103 there is air. There is air for many percentage points, and that is very worrisome. I don't like the shape of the moving averages on the weeklies, nor on the dailies. Everything is turning upwards. The pressure is upwards. I think the central banks will have to, in some way, mitigate this, and I'm sure they will try. But they normally don't act until something has happened. They don't act when it's at 100 to stop it going to 105. They act when it's at 105 to stop it going any higher. So to me, the danger is that the dollar starts appreciating. I think people will, over the course of time, realize that the deglobalization phase actually sucks dollars out of the rest of the world and into the dollar block. Let's say that whether that includes Mexico or other parts where the US can control the supply chain, but what it does, it sucks the dollars away from the parts where the US doesn't want them to be. Let's say it's only China. But that is very troublesome. That could cause a major risk-off effect in certain parts of the world, which, since we're still interconnected, will sweep through into others. You could have a real crisis in FX and ultimately in asset prices in the emerging markets, simply because you get defaults because there aren't enough dollars to go around and to repay the enormous debts that China has in dollars and other countries and other companies. So this is the potential wrecking ball that I'm looking at, and to tell you the truth, I'm very worried. If we can't stay, significantly below this 140 level, and if we start trading, above it towards the 101, I think the pressure with time will be for 105, 110. Just like that dollar chart is worrisome, this gold chart is just as worrisome. Don't forget that this is gold in dollars, so you can imagine what it's going to look like if it's in some funny currency. It's going to be boom, straight off the end of the chart, of the top. And that seems to me what is going on. I think people, mainly outside of the US, are anticipating a local crisis in local currencies and buying gold. And that is still driving up the price of gold. However much we are in a deflationary period, however much bond yields will stay low, or not go lower, and even if they went slightly higher, that would actually be bad, because if where you're going to put your money if not in the dollar, and by buying gold you're automatically buying dollars. So that is what worries me, and it seems to me that if we start breaking and maintaining these levels here around 1750, eventually we have to get to 1900. We've tried so many times to go down towards this 1667 level. We've failed to remain below it. We've bounced off it, not to talk about the 1458 level where we bought it. This is a chart to me that says there will be some sort of a risk crisis at some stage, mainly brought about by FX. I'm afraid of FX now. I really think that the dollar could start wrecking stuff. The main S&P chart basically says what Stan said: stability at these levels until the liquidity situation changes. The relationship between the S&Ps and TLT is very stable at the moment, and therefore the price of SPY is going to be very stable too. What happened last week? Last week basically we rejected the 2950 area and we dropped down towards the bottom of the Bollinger Band. I was hoping to buy it at around this 2730 level. Failed by a whisker, straight back up to the middle of the Bollinger Bands. If we enlarge this area, we will see how it's basically playing ping pong with all the moving averages, which are all bunching together. To me, this says that this is a period of complete indecision that will keep on going up, down for no reason. The Bollinger Bands are all straight. You can see how the top one, 2954, bottom one basically just above the low. It's, 2758. That is your range for the time being. If it stays below 2864, these averages slowly start turning, and the pressure starts being exerted on the downside and the 2730 area. That is the danger for the time being. but certainly if I saw it at 29.54, I would not be surprised. Uh, I would not be even surprised to see it take a leg higher to 30.28. Above that, I would be very surprised. To me, the range for the time being is somewhere between 30.28 and this is longer term. This is for several weeks and months. 30.28 down to this 26.75 area. But things will change fast, and things will change fast if the dollar wrecks it. That is my, that is my worry. If the dollar starts wrecking stuff, we are going down in risk assets. Probably least in the S&Ps, but it's going to be a very worrying time for the world. If there aren't enough dollars to go around, the equations and everything we have in our head at the moment could really change. But if we look at a weekly chart, I mean, things don't look nearly as bad. For stuff to start looking bad, we really have to start closing below these moving averages here, which are, what are they here? These levels here, 28.40. Call it, 28.30 or whatever. We need to start closing the week below there to start making pressure for 27.28 and this 26.75. I think it's going to be very unlikely that we can break this level for the foreseeable future. So, let the market guide us. I still think that any kind of dip down below 2800 is going to get bought in this area. I don't see any pressure, probably because there isn't that much pressure on the dollar at the moment, but I certainly think that this is the weaker side over the course of the next few weeks. But I still think that we're in a range, and this 1, 2, 3, 4, 5 week range is gonna be tough to bust it with the information that we have at the moment. SPY TLT, if you look at the previous videos, you'll see that this area, 191 to 183, is going to be my main resistance, and this is the kind of area that I want to sell equities and buy bonds. While we are meandering just below it, that means to me that the S&Ps are supported when they get down below 2800, in the low 2700s, and we have the very massive resistance between the 2954 and the 3028 level. Those are the very important levels, and when they coincide with the S&P's spread being somewhere around here, to me it's a massive sell in equities and a buy in bonds. But as you can see, very little change over the course of the past several weeks, and I anticipate this to continue while we correct, and then the danger will still be towards the downside, towards the latter part of summer, and that is precisely what Druckenmiller told you, that if the Fed QE gets overwhelmed by the Treasury supply, it'll be mainly seen in risk assets, and you will see this spread move down towards the lows. In conclusion, I want to address his last point, and that is the future and continued outperformance of NQ, i.e. of the tech growth, against the rest of the sectors and the S&P and everything else. This is a monthly chart, and you can see how we hardly even got to the 0.382 retracement of the move, and straight back to the top of the Bollinger Band on the monthlies. You've heard me say many times that the monthly Bollinger Band works extremely well, and it's very unlikely that we can just stay above it. we backed off duly. And really, it's likely that we will meander around this level, which tells me that the S&Ps will have some sort of pressure on them, but nothing, nothing fantastic. That's just, the overall big picture. You cannot argue with this trend, can you? I could show you the spread against S&Ps, but basically it's a one-way street. And I think that he is quite right that the overall secular trend is for higher tech growth, of course, with bumps in the road. And in trading, we look for bumps in the road or for levels that are good buys. Now, this is a completely different chart from the weekly in the S&Ps, isn't it? You have very clearly upward sloping or not downward sloping MAs on the weeklies, which give you clear levels of support. The big level of support in the Nasdaq is around the 8200, but before that, just below 8700. I'll call it 8650, 8660. These are, the levels that I would suspect that we do not break in Nasdaq unless we're going to break big time in the S&Ps, and I just can't see it. So your buy levels are anywhere between 8700 and 8650. Closes below there would argue for a move down to this 8260, 8200 level. I do not anticipate it. I think this first level is where you want to buy the secular growth story. Okay, thank you very much indeed, and tweet you on Monday.